Are you thinking about refinancing your property to pull even more money out? Well, you better watch this video before you do so, because there are some tax implications you need to be aware of. Hey everyone, my name is Simon Leeds and welcome to another video. I want to talk to you today about how you can refinance your property portfolio. Before I get started, I was really interested to watch a video by Samuel Leeds who talks about this very subject. Let's have a look at what Samuel Leeds has to say about refinancing your property. Let's take a look.
What is a refinance? How does that work? A refinance is when you get a mortgage on a property, but you do it after you bought the house. You could buy the house, for instance, you could buy it in cash. You could buy this with your own money. I'll buy this house for 100 grand. And then the house maybe goes up in value and it becomes worth 150 grand. It's gone up in value. So you've made £50,000 in equity. Your house is now worth more, but you only bought it for 100. At this point, you go to the bank and you say, hey, I've got this house. It's worth 150,000. I bought it for 100, but it's gone up since then. I did a bit of work on it. The economy's lifted. It's gone up. Can you please lend me 80% or 75%, whatever you can get? Please can you lend me 80% of the value of the purchase price? So now they're going to give you 80% of the value of this house. They're going to give you 80%, of which you can use that money to buy more houses. So as long as they have the charge on the property, and as long as they're not going to, over leverage would be if they said, and this is what the banks were doing in 2006, sure man, you could have 100% mortgage. In fact, you could have 125% mortgage. They were going crazy. So that's what it is. So to answer your question, what's a refinance? A refinance would be, and this is why as a property investor that you can maximize off of this. What you can do is you can say, I'll buy this house, I'll buy it for 80 grand, and I'll get a bridging loan. A bridging loan is just it's not really a mortgage, it's just like a short-term loan, which is used for property usually. So you could buy it for £80,000 and then add value to it, or wait for the property to go up in value, and then you just get a new mortgage on it. And then they'll lend on against the property, against equity on the property. So that is what it is. I hope that answers the question from Armani about you can't wrap your head around refinancing.
Alright, so Samuel Leeds is pretty much saying that you can refinance your property if you add value to it, or over time it increases in value. It's a great tip that you can pull more money out. If you have not subscribed to Samuel Leeds' channel, make sure you do so, because he's got some great videos that you should be watching that will help you to invest in property with a lot more return on investment. So make sure you do that. And at the same time, if you haven't done so, make sure you subscribe to this channel by pressing the button below and the bell notification so that you don't miss the opportunity of watching every new upload. Alright, so now we're talking about the benefits now of refinancing your property. Well, the first benefit is, as Samuel has already mentioned, you are going to be pulling money out of your property deal. That means you've got more money to play with. You might wish to then invest that money into the next property investment deal. Therefore, you don't need to rely upon your salary, you don't need to rely upon your joint venture partners, you're just pulling that money out from an existing deal that you already have. That's great news. So, the next side of it is that you are going to increase the return on investment, because if you're pulling money out of the deal, that surely means that you've got less money still left in. By refinancing your property, you're also demonstrating to the banks that you are a savvy property investor. You're going through another mortgage application, which has got to be in your favour. So hopefully it's helping you with your credit rating as well. But we do need to think about the disbenefits of refinancing your property portfolio. And the first one I would highlight to you is the fact that you are increasing your overall debt. Increasing your debt, which needs to be paid back at some point in the future. And let's imagine that you take the more money out. Let's imagine that you take 30, 40, 50,000 pounds out of the property deal in question. And you don't reinvest it. Instead, what you decide to do is go on a world cruise. Well, that's great. Everyone should have time to enjoy themselves. You work hard. You should play hard at the end of the day. So you've invested that money in you, not into your property portfolio. Well, that money's got to be paid back. And ultimately, you've increased your debt levels, which means you've decreased the equity position of your portfolio. And you could be in problems because if, let's imagine, that there is a downturn in the property market and all of a sudden the property values start going below the mortgage that's still outstanding because you're on mortgage interest rate only. Well, the banks have a right to say, well, we want this money back now because we can see the property values going down, you don't have enough cover, therefore you are breaching your terms and conditions, so you need to top that up, or indeed you have to sell your property portfolio. The second one, in terms of disbenefits, is the fact that you've got greater mortgage interest cost, which naturally means that you are decreasing the amount of cash flow that property is giving you each month. I'm going to go through another example later on. Okay, so now we can talk about what happens when you refinance your property. So you purchase a property for £150,000 and over time the property is increased in value to £250,000. That's a £100,000 increase. That could have happened because you've refurbished the property to make it better than what it was, or just the fact it was in a good area and over time there's been natural increases. Now, because there's been that increase of £100,000 and you go for a refinance, you may be able to pull £75,000 out of that deal. So that's money that you can either reinvest into your property or £75,000 that you can reinvest in yourself. That is up to you. So before we go any further, guys, have you thought about refinancing in your property portfolio before? If so, please in the comments box below this video, type in yes and explain how you refinance your property and what it's done for you. If you haven't refinanced your property, but you're thinking about doing so, but you have these real niggly little questions, then make sure that you type those into the comments box below so I can answer them within 36 hours. Alright, so before you had this mortgage of £112,500, but as we said before, the property value has now gone up to £250,000, which you can now extract 75%. The mortgage value is now £187,500, which means you're extracting an extra £75,000. So before we talked about the fact that you've got £62,500, that's literally money you've put into the property to buy it, deposit, refurb, etc. Now the fact that you was able to refinance your property investment and pull out £75,000, you're now in a position where you pull more money than you invested. So the return on investment will be infinite. And in fact, over the scheme of things, you've now got £12,500 out in your pocket from your investment. You've got no money tied into that deal whatsoever. And that has got to be a very good result indeed. So how many of you out there listening and watching this video have reduced their kind of cash flow, but been able to pull out more money out of their deals than what they had in originally? Please share your stories with me. It'd be really fascinating to understand the situation you've been before and what has happened after you've refinanced your deals. So what we need to do now is compare and contrast. We need to have a look at how much money that you made before the refinancing and then how much money you'll be making after refinancing. And the reason for it is because of two things. One, there's a greater interest rate that is going to be affecting, more interest cost to you per month. And you're also going to be affected by Section 24. So we need to have a look at the calculation of how refinancing your deal will be affected by Section 24. So let's be in a situation here whereby you've got a rental income of £10,000. You've got 30% costs. Now, these 30% costs it could be any percentage you like. But I've used 30% because I'm looking at 10% voids, 10% maintenance costs, and 10% property management fees. So all in all, I'm saying it's 30%, but again, you can be kind of using your own calculation on this, but I'm going to assume that it's £3,000 per annum for these type of costs. We've also got the mortgage interest costs. Now these are mortgage interest costs before the refinancing. Next we have mortgage interest costs, which is 3,375. These are mortgage interest costs before the refinancing took place. So all in all, you are now left with an annual profit of 3,625 on this residential property before you did any refinancing at all. Alright, so let's have a look at the return on investment before you did the refinancing. Alright, so you've got profit of 3,625 as we've just explained. You've also invested in your own money of 62,500. So we need to divide the profit by the amount of investments times by 100 gives you the return on investment. And in this situation, we've got a 6% return on investment, which is not bad actually if you think about how much percentage rate you can get in a bank account. So would you be happy with this deal? Well, not everyone would be, but for a majority of people, 6% is a good return on investment. Alright, so let's now compare what we had before with the profits against what happens when you refinance your property. You've still got the £10,000 worth of rental income. That's not going to change, is it, by refinancing? You've also got the 30% cost that we talked about. Again, you may vary this up, but we've assumed £3,000, just keep like for like. But now our mortgage interest costs have gone up, and they are now 5,625, which, because there's more mortgage interest costs, that means our profit for the year has now decreased. The profit has now decreased to £1,375, which is a significant effect because we have now refinanced our property. Now, I appreciate you might want to refinance your property to buy further properties, which you would make up that difference. But for this specific property, we are now making less money than we did before. Now, as we mentioned before, we're taking the 3,625 profit that we made before, divided by the amount of money we invested of 62,500, gave us 6% return on investment, which we all thought was pretty sensible, pretty good. Now, what happens when we refinance our deal? We've already said that we've extracted all the money out. In fact, we've got more money out of the deal than we put in. So we're cash negative, really, in terms of the amount of money we put in. As a result, it instantly means we've got infinite return on investment. And from my perspective, that is a pretty good deal. But we do need to consider, though, how much of a cash flow impact this has had because we've refinanced our property. Are we looking for cash flow each month, or are we looking for infinite returns? And again, don't forget, guys, if you are reinvesting that property portfolio, you may well be making your money work harder. But if you're taking that money and doing something else with it, you've got to bear in mind that your cash flow is now going to be affected. Alright, so the next section is Section 24. How does Section 24 affect your property because you have now refinanced your property deal? Before we go any further, guys, make sure that you press the subscribe button and the bell notification button so you don't miss out on any future video. And if you've got any questions, concerns or niggles, then please feel free to type in those questions in the comments box below this video. I will be sure to answer those questions as soon as I can, typically within 36 hours. Alright, so let's get back to section 24 and how is this going to be affecting your property portfolio because of the refinance. If you haven't watched my video on section 24 yet, please make sure you do so by pressing this link above to watch that video of how section 24 mortgage interest relief cap can affect your property portfolio as we go through the years to 2021. Now, as that video would have described, we need to take into account now when we're performing our tax calculations, what is the profit if we do not extract the interest from our calculation, which basically means we've got to forego any mortgage interest costs against the profits. We know now we've got £10,000 worth of rental income coming into our coffers and we've got £3,000 worth of costs going out for voids, maintenance and property management fees, which leaves us with £7,000 worth of profit. And that applies before the financing and after the refinancing because we're ignoring the interest line altogether. Okay, so we're in a position whereby we've got, before the refinancing, we've got £7,000 worth of profit. Well, that's the same, irrespective, even after you're refinanced. So the profit of that needs to be taxed at 40% across both before and after the refinancing. That's not going to change at all. What will change though is the mortgage interest tax reducer. So the tax calculation of $2,800 will be reducing your net cash position of £7,000 worth of profit, but we're going to add back now the tax reducer. The tax reducer is in effect a tax credit which HMRC will give you at 20%, no more, 20% of the mortgage interest. And because before the refinancing, the mortgage interest cost is less than the mortgage interest as it is now, you will get less mortgage interest tax reducer. So the tax reducer before the refinance is $675. The tax reducer after the refinance is £1,125. So the net profit is $4,875 before the refinance, but it's going to increase to $5,325 because of the tax reducer that we're now getting. Don't be too excited, because now we've got to take into account the mortgage interest, which has got to take away from that net cash position. But now we've got to take away the actual mortgage interest cost from this calculation. And before the refinance, we had a mortgage interest cost of $3,375, meaning that we've got a profit of £1,500. So you've got $5,325 profit after you refinanced, but now we've got to take away the actual mortgage interest cost of $5,625, which means, wow, you're making a loss of £300 per annum on this property. So you refinanced, taking all the money out, but now you're losing money each single year. And if you have a big refurb, you're going to be in a bad situation with this particular property. So you have to take it into account. Yes, you pulled money out. Yes, you pulled infinite returns if you made a profit. But as you've seen here, you're actually making a loss on this property because you have refinanced, because of the effect of section 24. So guys, before you refinance your property deals, make sure you understand from a tax position how it's going to affect you, not just from a cash flow perspective. So has this been helpful? Press the like button if it's been helpful, or indeed if you've got any questions at all, please make sure that you type those questions into the comments box below and I'll be sure to answer those within 36 hours. Don't forget, I'm going to be here every Monday evenings between 7 p.m. and 8 p.m. to answer your property tax questions. I'll also be going through what's in the news, identifying everything that's been said in the tabloids, in the press releases about property tax, and indeed what questions our clients have been asking last week and how I might be able to help you in the future with the solutions we've already provided to them. So don't forget to join me at 7 p.m. on Monday evenings, and until then, my name is Simon Misiewicz from Optimised Accountants. I'll see you again soon.